Hello, everybody. Back with another video here. And in this video, I do want to talk about the product that I offer. For reasons that I'm going to talk about that, I want to do all my compliance stuff. My name is Ben Stepp. I work for Reliant Bank. My NMLS number is 512149. So the product that I offer, what I originate mainly, is what we call a first lien home equity line of credit, or a first lien HELOC. You may be familiar with HELOCs and how they operate. Some of you may have had a second position. Some of you may have had a first lien HELOC. But just to give you a little bit on how it works, is that it does operate like a home equity line of credit, like a line of credit will, where it allows you to pay down the balance, reutilize funds. So if you've got a $50,000 second lien HELOC, then you can pay down that balance and reuse that money, whether it be for upgrades that you're doing to the home, or you have to purchase a car, or like we had to do once an HVAC system when ours went out, that kind of thing. So if you pay down the line, then as long as you're in the draw period where you can redraw those funds out, then you can continue to utilize that money over and over again. Now, this is what I talked about in the first video, the liquidity aspect of it, and this is why it's so significant versus having your equity locked up in a traditional mortgage. Okay, so what the line actually allows you to do is, first and foremost, it would pay off your current mortgage. Okay, so whatever you owe on your current mortgage, it would pay it off, and then it will set you up with a maximum line of credit depending on what you can qualify for. So loan to value based off of what your qualifications allow for, whether it be debt to income or credit scores, all those requirements kind of set you in a box that you could qualify for. But to give you an example, let's just say your house is worth $250,000 and you owe $185,000, which puts you roughly around 74%. Okay, and let's say you can qualify for the first lien HELOC up to 85%, which would put you around $212,500. In that example, that frees up about $27,500 worth of equity for you. So we would pay off your current mortgage of $185,000, and then you would have an additional $27,500 available to you to utilize on the line of credit. Okay, now if you don't take that money out, if you never utilize those funds, then you never pay interest on that money, which is key. Okay, so you only have an interest-only payment based off of $185,000, which is what you currently owe. And if you never touch that money for anything, then you never have to pay any interest on it. You only work on paying down the $185,000. And there's a strategy behind this, which I'll get into in a later video. But again, I want to keep these short and talk to you about the product itself versus the traditional mortgage set. So now, nothing wrong with banks. Okay, I work for a bank. I'm not saying that I'm not one of those banks are evil kind of people, because it's just not true. We utilize banks for many different reasons, and most specifically in the market that we're in today, we utilize it for mortgages on our homes. Okay, all I'm saying is that I believe that the product that I offer is a better vehicle for most people. Not everyone, but most people. Is a better vehicle for you to use to either pay off your home or to continue to reuse that equity, the liquidity of your equity over and over and over again. Okay, and the reason why I say that is because the first lien HELOC allows you to use all the money that you make, every bit of income you can use towards paying down your home without locking that money up in the house. So on a traditional, if you make extra mortgage payments, okay, which is great, if you're doing that, it's a fantastic way to pay the home off, which is eventually where you want to get to. Okay, but if you do that, then let's say the $500 extra that you send in, you can't get that back out. That's money. It's in there. It's equity in the house, and it's locked unless you sell the home or do a cash out refinance. With the first lien HELOC, not only can you utilize that $500 extra, but let's say you have the ability of putting $700, $800 in savings every 2 months. Okay, so $350 a month you're putting in a savings. Well, if you use the first lien HELOC like a checking and savings account, now that money goes into your HELOC as well, which pays down your principal balance which lowers your monthly payment the next month. Okay, there's a lot of detail to this. I'm more than happy to speak to anyone who wants to know more about it, lead you to an educational website that we have out there that kind of explains it in detail and puts it, down on paper for you, something that you can see. But again, in the effort to keep these videos on the lower end of time, then I do want to cut it off there and kind of talk about a little bit more of that in the next video. I hope this information is good for you. Praying for all of you all out there with the current situations that we're going through, and I hope everyone's doing all right. Talk to you soon.